Okay, well, good morning, everybody. Usual format. I'll run through some news, and then we've got a special guest this week. It's Milena Mileva, who's the co-manager of Baillie Gifford UK Growth, which they've been running for a couple of years now. So I think it'd be quite interesting to see what state they're at. They've just announced results this morning as well. The way we're working, so this week we're using Zoom. It just seems to be an easier thing to do. Sure, far more people who have access to it. So the way you can ask questions is through the Q&A function on there. So if you've got a question, just put it into there and we'll get into it. But we'll cover those things off at the end. If for whatever reason you can't use the Q&A function, just email me at jc@martinandco.com as usual. So it's actually a relatively quiet week for news this week. So three things that I just thought interesting things that we'll have a quick look at. And I will keep it quick, even though I've got quite a lot of slides in them. So Ciena, which is the sort of venture biotech company, SIBA, which is a fund dedicated to Cuba, and Edinburgh Investment Trust, which obviously we all know and love all those according to our history with it. So Ciena just put out some results recently. On the face of it, they should have been fantastic. They did two big disposals during the year, which actually were sort of cooking earlier before that, so it was already sort of in the NAV. But selling two of the portfolio for really quite chunky sums was good news. And you can see what fantastic results they made. They sort of 10 times the money they invested for one and 4.5 times for the other. But the NAV dropped by 13.3% over the year to the end of March. And the reason for that was its biggest holding is in a thing called Nautilus. And that is a listed company, and the shares fell by 81%. So you can see what that's done to Ciena. It does tend to trade at a premium, which is quite chunky. But it's really quite volatile too, as you can see there. The fantastic results they got with Blue Earth and Nightstar fed through into that run up in 2018, but their shares have been sort of drifting off since. And now the premium is a lot more modest, so it's about sort of 13%, I think, today. And there's the Nautilus share price. So you can see the massive drop in that from the peak, and a small recovery now since the lows of March 2020, which is a sort of similar shape we're seeing for a lot of stocks in the market. Woodford was a big investor in Nautilus, and this is one of the reasons why their shares were going down. So there's obviously a big overhang of stock. I suspect it's one of the reasons it ended up being quoted in the first place. To my mind, these things, when they're at this early stage, they shouldn't really be quoted companies. Ciena really agrees with that. And they've generally, that's not the way they're going to go with these things going forward. So they'll seed investments, they'll grow them until they're a decent size, and then they'll look for an exit, whether that's a disposal or a listing, but only when the things are much more mature. There was some stock-specific news that might have hit a sentiment. So they've got a variety of candidates. What they're doing is they're engineering T cells to attack various diseases, mostly blood cancers. And two of the clinical trials that they've had running, they discontinued. And I think that was seen as bad news. But this morning, actually, they've announced some more clinical data, which seems to be going in the other direction. And it is remarkable what they're achieving with some of this stuff. You might remember, if you watched the BBC's War in the Blood program, it's the Nautilus program that they were looking at. So Ciena is not all about Nautilus. They've got a variety of things. You can see on the slide here. So Freeline, Gyroscope, Achilles, Swan Bio, and Quell, OMAS, and Azaria on there, all at various stages, mostly still too early to think about writing up in value. So they're mostly held at cost. And this is some of the stuff that they're trying to do. So Nautilus, as I've said, is targeting using T cells to attack various cancers. So that DLBCL thing is white blood cell cancer that causes problems in the lymph glands. So they've got patients that they're tackling with that. ALL is acute lymphocytic lymphoma for adults. They're doing that now. FreeMind targeting haemophilia B. And what they're doing there is they're looking at ways of doing gene therapy, so taking defective genes, so the genes that cause haemophilia, and also FreeMind's looking at a thing called Fabry disease and another one called Diatras. And they're trying to cure the problem by replacing mutated genes. This is a way of curing things that were previously completely incurable. And you can see what the potential for this sort of market is if they can pull this off. Really very exciting indeed. Gyroscope is targeting dry MD, which is a disease that affects eyesight. About 1 in 70 people in later life. And if it's not treated, it will cause blindness. There is another treatment available, but this one is far less invasive, and that should mean it has a much higher take-up. Achilles is a sort of similar thing to Nautilus, using T cells, but it's going more after solid tumours. And one of the things it's trying out, first off, is attacking lung cancers, but also you can see there melanoma, just skin cancer. And then, well, I could go through all of them, but it would take too long. But basically, they've got a whole range of different things here. A lot of these things are curing diseases that were previously incurable, as I said. And it's that attraction, I think, that makes Ciena so exciting. There has been a problem with COVID in that because hospitals have been repurposed to fight the disease, that has meant that some clinical trials have been halted. That's tended not to be as true for cancer treatments, because people understand the need to get on with treating some of these things that, if they can. It's not, even though it's a delay, it's not the end of the world. Ciena has got a huge amount of cash held back. And that's because it sees too many promising British biotech venture startups fail for lack of money in the past. And so the whole ethos of this is that it keeps back enough money to be able to back these companies through to maturity. And so it can definitely cope with a sort of 6 months, 9 month delay in the clinical trials. And it's also announced yesterday that it's got one new investment that it's looking at, and it's already got 1.4 million invested in it. It was a thing they did with the Wellcome Trust, who were one of the original backers of Ciena. And it's targeting liver disease using what they call macrophages. So exciting stuff, and good news for all of us who've been drinking too much at home during the lockdown. So that's Ciena. SIBA, this was something that a lot of you probably won't have heard of. It's a Cuban property company. It IPO'd, or it came to the UK market in 2018. And you can see the attraction. I mean, it basically owns a chunk of hotels and a conference centre in Cuba. And it's one of very few ways, really probably the only practical way of investing in the country. However, it's in this sort of funny property rest of the world sector, and it's pretty much unloved. You can see it's trading on a 50% discount. Now, there are lots of good reasons for that. Trump is probably the main one. Actually, the economy is not too bad. It's just never sort of realised its potential because of sanctions. The US imposed a thing called Helms-Burton Act in 1996 that imposed various restrictions. But some of these started to be lifted under Obama. But when Trump came in, I think just to go for the Cuban-American vote, he got much more strict on the stuff. And they introduced a thing called Title III, which was in the original act but never actually used before, which in theory allows Cuban expats to sue for the recovery of property that they lost in the revolution. In practice, SIBA says it hasn't got any exposure to that sort of thing. but it more sort of practical impact on a business that's reliant on tourist arrivals. He increased the restrictions on the amounts of flights that could go to Cuba again, and stopped US cruise ships going there, which is a big loss of revenue. He also stopped the amount that Cuban expats could send back home again, and so I think that's limited to $1,000 a month or something. Now you can see what it's done to tourist arrivals. So they were ramping up quite nicely, and then they dropped. The USA wasn't a huge component of tourist arrivals because of the historic restrictions. Actually, the main chunk of visitors comes from Canada. But the potential, if it's opened up, is enormous, because really it's on the US doorstep. It's relatively easy to reach. If people could go there, they definitely would do, and that would be very good news for SIBA. So it's got the trade centre in Havana. It's got a 5-star hotel in Havana as well. It's got 3 hotels in Varadero, which is a peninsula off the north coast, which is sort of set up for tourism. And it's got a hotel under construction in Trinidad. And it's got plenty of cash too in the various subsidiaries that control these things. So it's not going to run out of money. But COVID's obviously a problem anyway. And even if Trump hadn't have time to put all the restrictions in place, there has been a ban in tourists since 20th of March, which hasn't yet been lifted, but might be soon. But Cuba's done very well through the whole COVID thing. It's definitely a lot better than most of Latin America. So only 83 deaths, and that seems to be, the number of cases seems to be almost stopping rising. So they are, I think, thinking about opening things up again. They're going to test everybody when they arrive. But because of the impact of all of this, SIBA decided the best thing to do was not to pay its dividend this year. That's been a bit of a problem in terms of the investment case, which I'll come back to. So 50% discount. If they reinstated the dividend back to what it was in 2018, it would be on an 8% yield. But the big upside, to my mind, is if Trump loses the election, because almost anybody else is going to have a much more relaxed attitude, and that could just reverse the whole negative thing that's been affecting them today. So that's that one. And then just very quickly on Edinburgh Investment Trust. As you can see from this rather big table, there's an awful lot of UK equity income trusts, far too many in my opinion, and there needs to be some consolidation. So when the Edinburgh contract was put up for grabs, I didn't expect this one to get merged away, but I figured some of the other ones might be in time, as we talked about before. This is still a reasonable size, 800 billion market cap, but I was quite surprised by the choice of the new manager, who's Majedi, who's still maintaining this kind of value style of approach, and I'm sure Milena would have some strong views on whether that's a good idea or not. It's on about a 12 discount and a 6% yield, which the 6% yield you think would be attractive, but the performance is really not too great. So this is, I've just ranked everything in that sector on the 5-year NAV return, so you can see that it's very much down the bottom. Yeah, really not too good. So that's losing money every year for 5 years. This morning, they've come out with the results, and they're not great. But one of the things that is sort of buried in there is that it does look as though they're thinking about cutting the dividend, which removes a lot of the attraction, I think. These are the reasons that they've come up with for why that's a good idea. They think companies need to preserve liquidity. I think that's definitely true. If you're struggling, it makes much more sense to keep money within the company and invest in the future rather than paying out as a dividend. They're expecting around a 40% drop in the amount of income available for 2020 anyway. But of course, they've got reserves that they can dip into. But they think these only give you kind of short-term flexibility. And they also think that the COVID-19 impact is going to be relatively long-lasting. So all of that seems to me that they're hinting quite heavily that they're going to think about rebasing the dividend. which will make new managers' job a lot easier when it comes to constructing the portfolio. So we shall have to wait and see. So from a problem company in the UK market to more of a success story, let's now talk to Milena. If I can unmute her. Let's have a go. There we go. Good morning.
Good morning.
How are you?
I'm very well, James. How are you?
Not too bad, thank you. Not too bad.
Is my video on or just checking?
Sorry?
Is my video on or I'm not?
No, we can't see you, but we can definitely hear you. So,
right, great. Sorry, I don't know why for some reason it's not on.
Yeah, don't worry. We'll sort the technology out another time. But definitely, that's not the end of the world. We can keep chatting. Yeah. So really, I just wanted to chat through because you just announced results this morning.
Yep.
So and they look pretty good relative to the UK market, anyway.
I think that's the key, James. I think there's I suppose pleasing that we've outperformed, but we have lost money for shareholders during this past financial year. So I don't think the mood is euphoric, but it's pleasing that we've held up better than the market, certainly.
So what are the drivers of that? How have you managed to pull that off?
Well, I think I suppose we are invested in companies. One of the key things, I think, James, and we certainly did a lot of kicking of the tires in terms of the resilience of the portfolio when COVID, and particularly the more widespread lockdown measures kicked in Europe and the United States. And I think one of the key drivers must surely be the fact that relative to the benchmark, our portfolio companies are not particularly geared. So I think the issue of leverage has been on people's minds, understandably, given the big revenue shocks to a lot of businesses inevitably from this dreadful crisis. But I think where we've held up well is just in general, our companies are fairly resilient financially and have very adequate liquidity. Which allows them to withstand the temporary shock. And I think in some cases, hopefully allows them to come out the other side stronger and hopefully able to take some market share from weakened competitors. I'd imagine that probably is the key driver, James, to that outperformance, particularly year to date.
Are there any companies that did particularly well?
A couple of our more resilient companies have done well in the healthcare area. So we are very long-standing holders of Genus, which is an animal genetics company, and Abcam, which is a life science tools company, and both of those are fairly resilient to the current environment. We're obviously mindful of potential second and third order derivative effects, and we monitor those closely as events unfold. But in the first instance, they are fairly resilient, so they've certainly done well. We have a holding in Boohoo, which is an online apparel retailer, and that has been performing pleasingly. I suppose there's an inevitable shift towards more online spending when stores are closed. But I think which is, I suppose, to my mind, is more pleasing for Boohoo is they've significantly outperformed their other online players. So I think Boohoo is gaining market share, not just from brick and mortar physical retailers, but also some of their online peers. It continues to execute very well as a company. So I think these are some of the key ones that have been helpful.
Yeah, I think it's going to be interesting to see how persistent it is that we all do our shopping online. Actually.
Yeah, indeed. Yeah, it's something. I mean, this is clearly some businesses are given a bit of a boost the minute from the current circumstances. The online food delivery platform Just Eat is strictly speaking in that camp as well, where trading is being helped a great deal by the current environment. But to your point, I think the crucial questions here are how sticky are these these changes in consumer behavior, or the acceleration of these consumer habits anyway.
Exactly. Now, you've been running the fund for a couple of years, and it used to be Schroder UK Growth. So I know there was a huge reorganisation of the portfolio when you took it on. So what's the sort of shape of it now? Sort of the balance, because it's a UK all cap fund, but it's not. It's probably kind of more small cap weighted than the market is. Is that true?
I would suggest it's more in the mid cap space, mid to small cap space. James, certainly. I mean, we are, and the nature of this. So I guess if I just take a step back and remind maybe or explain, I guess, some of the key attributes of our approach, which I think are important because they define the shape of the portfolio. The first one is, I guess, as you might know, we exceptionally long-term investors. So our portfolio turnover in this financial year that's just ended has been just a mere 5%, just over 5%, which is clearly quite a bit below industry averages. The second one, though, it's important, and it comes to your point about the shape of the portfolio, is we're very, obviously highly active fund managers. So our active share is very high, 86%. I guess our belief has been that there's this tendency for investors to sort of shy away from taking positions that are very different from the underlying benchmark. And I think one could argue with some justification that in the UK market, the structure of it is such that, as you know, it's dominated by a handful of very large companies, your big oil companies, the tobacco companies, pharma, the big banks. The structure of it is such that I think that tendency to shy away from being very different from the benchmark is exasperated. And our philosophy has always been that we see an issue with that line of reasoning. We think that actually to deliver outstanding returns for our shareholders and clients more broadly over the long term, we need to be as different from the benchmark as possible. Now, clearly, it's not a sufficient condition. You need to obviously pick the right companies, but it is, I think, a necessary condition to generate attractive returns for clients over the long term. So we don't have anything in the big oil companies, which certainly in the short term has been helpful. I mean, God knows where the oil price goes in the next couple of quarters or a year. And as you know, it's a mug's game trying to predict these things. But we don't have anything in the big oil companies, anything in the banks, tobacco, the pharma companies. So we are, by nature, I suppose, if you think about it relative to the benchmark, and as I said, we are very agnostic, so we don't let the benchmark direct where we go. But if you think in those terms, I guess the portfolio is more exposed to the mid to lower, I guess, smaller cap end of the spectrum. I suppose one of the main reasons for that is that we are, and it's the third really key attribute here, is we are unashamedly growth investors. We're looking for companies that genuinely have the potential to be much larger businesses in 5 or 10 years' time. And I think we struggle to convince ourselves, and we might be wrong on that, but we struggle to convince ourselves that say the banks or tobacco companies or the big energy companies fit in that camp. We just don't think they can be much larger, and they in fact grow satisfactorily over the next 5 to 10 years. So
that makes sense to me as well, I think.
Yeah, that's where the biases, I suppose, come in. Is that, as you say, that I guess skew towards the mid cap part of the market.
One of the things that Baillie Gifford's sort of become more and more known for is investing in unquoted companies within the trusts, which from a liquidity point of view makes perfect sense. And we heard the story last week with Scottish Mortgage about why that's attractive. But what's the position with this fund? Have you got any unquoted investments yet?
Not yet. The investment policy of this fund is such that we would have to come to shareholders for approval for unlisted, and it clearly is a board decision. We are, as I suppose, as managers, we are like our colleagues, enthusiastic about the opportunity to add some value for shareholders through investing in some attractive unlisted companies. You were talking about Ciena earlier on, but I guess we need to convince ourselves, and of course have the conversation with the board, more importantly, and reassure them that we have the capability to do that successfully. As managers, Ian and myself in our careers have been public investors, so this is a newer area for us. So we're spending time with our unlisted colleagues in Baillie Gifford. We have, as you say, very established infrastructure internally in this area. So we're spending time with our colleagues trying to get better in that area, and hopefully at some point this trust will have the capacity to invest in private companies as well.
Cool. And then the last question I had was really about what's COVID-19 done to the portfolio. Because I know you did have a position in Carnival Cruises, I think, didn't you? We did. This is one of we've made very few changes on both the buy side, I suppose, and the sell side as a response of this. The one change we have made is selling our position in Carnival. We did that fairly early on. And the issue with Carnival is it was just a combination of gearing, uncomfortable levels of gearing, and obviously very high fixed cost base. At a time when the demand backdrop is dreadful. It was just the confluence of all of these things, and I suppose some doubts over the ultimate shape of the recovery for these companies. Once we get through the worst, that led us to make that decision. It's not unlike us. It's certainly not panic sellers or anything like that, but we just thought the combination of factors here is uncomfortable, and it is likely to result in some significant dilution to shareholders, which of course it did eventually with some of the raisings. Sure. Okay. Right. Time to answer some questions from the listeners now. So a couple on the Q&A. So if you've got any other questions, put them on the Q&A, or as I said before, just email me on jc@martinandco.com. So the first one just says, you might achieve a good proportion of outperformance from a relatively small number of stocks. To what extent will you run those winners and allow them to become a larger proportion of the portfolio? I think that's very much our style. We do that. Is our style. We would genuinely let our winners run. So it is something that the shareholders should expect. Okay. Is there any kind of limit on the largest size of the position in the portfolio? As long as clearly stating the obvious, I guess, as long as we continue to have real strong conviction that we have a differentiated view. I mean, these things are all well and good, but you have to believe you genuinely have an insight relative to the market. So if we continue to see that, then we're comfortable letting investments run and not trimming them prematurely. Cool. Okay. Is there any flexibility to invest in overseas stocks? That actually links to a question that's in the back of my mind. Is that whether you feel that just investing in the UK is too restrictive? The answer to your particular question, James, is no. I don't. We are finding loads of opportunities, and I think what's potentially exciting about the current situation, and unfortunately we've seen quite a quick rebound following the panic in March. But God knows what's going to happen in the second half of this year and beyond. But what's potentially exciting is that we might be offered some great opportunities, companies that we have followed for some time, but where, for example, valuation has been a stumbling block, and we could well have an opportunity to purchase those for the trust. So the answer to your question is unashamedly no. We find quite a lot of attractive UK growth ideas. There is, in answer to your listener, I guess, that there is a scope to invest overseas. I have to be right on the numbers here, but I think our investment policy is that something along the lines of 85% or more of the fund needs to be in up to 85% needs to be in UK equities. So there is some scope to invest overseas.
And indeed, we have one small holding in an online luxury marketplace called Farfetch. It's a company that's headquartered in the UK, but it's listed in the US.
Okay, fair enough. Actually, as this is sort of related, but do you have any idea of what the portfolio's exposure to the UK economy is, as opposed to exporters, I guess?
I mean, again, it depends whether you think of it in. I mean, as always, I'm going to contradict myself because I obviously say we don't think in relative terms too much in terms of where the index is, but I suppose many people do. Relative, because the oil share is, as I said, dominated by a lot of these big international earners, the oil companies, the pharma companies. I think in relative terms we will be coming as slightly overweight to domestic economy relative to the oil share. Having said that, if you look at the individual stocks, the individual companies in the portfolio, I mean, it's only really the likes of Rightmove, Auto Trader, I suppose some of the investment platforms that have 100% of their business in the UK. The rest of the portfolio is either companies that are very much overseas exposed, or companies that I mean, have some UK business, but the skew is genuinely towards the global markets in Asia and Europe and US.
Okay, cool. Well, that was the next question, comes from two different directions. Asking about Brexit. Yep. So does it make a difference to the stocks that you're buying, or is it factored into what you're doing?
Not particularly. I think we are we've been very open, I think, and I hope with shareholders that we are highly unlikely to add value for them by making calls and making decisions based on macro events and politics. We just don't think we're good at it. We just focus on companies, making sure they are very strong. They're very adaptable, and we think that over time, these bigger, I mean, it sounds weird when you say it, but over time, these things come out of the wash. I guess when you have the longer term time horizon, if you're satisfied that the businesses you're invested in are genuinely strong and face very favorable demand backdrop, then you worry less about some of these issues. Of course, very important, but I guess from a purely investment point of view, we don't fret about them so much.
And actually, this kind of again leads into the next one, which is about gearing. So how do you manage gearing on the portfolio? Is it sort of running all the time, or do you actually sort of take it up and down?
We have not been geared. We are not geared as yet, and we have not been geared since we've taken on the trust. Actually, James, and there's been a few things in the background influencing that decision. I guess the very first one was there was a very decent chunk of this trust was invested in about 24% of it was invested in the Schroders ISA scheme, a savings scheme, which we were essentially forced sellers of. So we needed to get through that issue first, and we just felt uncomfortable gearing up in that before that was resolved. And then of course there's been all these issues in the markets around, well, first of all, Brexit. We just talked about Brexit and all the uncertainties there in the markets, and so we've so far not geared up. Having said that, we are very close to doing it, so I think shareholders should expect a modest amount of gearing to be coming on fairly shortly. I think there are opportunities out there. We will be very selective, so the gearing would be, as I said, negligible, just taking advantage of selective stock specific opportunities where we could purchase them by essentially gearing up a bit.
And is it kind of one in, one out for when you got the portfolio established now? How does something work its way in? I
mean, I suppose it's a fairly concentrated portfolio, and we're keen to keep it that way. So we would hope the barrier for new ideas is suitably high in that regard. But it's not necessarily a question of one in, one out. I mean, if we now, as I said, these are quite extraordinary times in many ways, and if we do see opportunities, we're very happy with the portfolio currently. But and if we see additional opportunities out there that could be very attractive for shareholders, then I think we'll be definitely taking advantage of that, and that's where the gearing comes in. Just allow us to buy these things without necessarily having to fund them from portfolio. We don't feel like doing that at the minute.
Okay, cool. Can we take them fast? One from Ed, actually. What's your favorite stock in the portfolio?
Oh God, that's asking parents to choose their children between their children. It's a very, very difficult one to say. Oh wow, there's loads. I mean, if I may talk, I suppose, as I say, I mentioned a few of them. I think, you know, Upcom Gene is a long-standing holdings and we're very confident in their long-term prospects. The likes of Renishaw, it's a very you know, all very long-standing holding for myself in some of the institutional funds I run. So I'm a believer in that one. But even some of these newer additions to the portfolio that we made over this past financial year, I'm hoping they will contribute very positively for shareholders over the next 5 years. Things like Games Workshop, which today had a very pleasing trading update, great to see. And the likes of Creo Medical, you know, you were talking about Syncona and some of the interesting smaller companies in the UK in the life sciences area. And Creo Medical, they make very innovative surgical endoscopes. So it's with fantastic outcomes for patients and taking quite a lot of cost out of the healthcare system, hopefully. So it's a very small company, it's pre-revenues, but we think the IP is great. The management team are very strong. And we hope it's one of these small UK companies that can become very successful and very large over time. So it's I'm sorry, I'm rambling, but it is genuinely hard to
How do you find something like that, which is that small and pre-revenue and? We
backed them right back when they IPO'd. But I think it was 2016 that IPO'd, and we took small holdings in some of our institutional funds, and it's a very liquid company. So the way we managed to purchase some for the trust, there was a liquidity event last year. They raised some money to start really accelerating the distribution plans in the US and Europe, and commercialization of the products. So there was a raising, a capital raise, and we managed to participate and buy a very small position for the trust. But it is a company we followed since it became public.
Cool. And the dividend is not something you really target, but actually, is it going to be sort of an upwards only thing, or will it just go up and down depending on how much revenue you've got?
Yeah, I mean, it's purely an output of what the companies are delivering. So our approach is very much for capital growth, as you know. Having said that, the underlying companies, a lot of them are delivering dividends, and I suppose they are. Our hope is that they're growth companies, fantastic growth companies, and they will over time grow their dividends as well as, and return some money to shareholders. But of course, if we were talking to them, and as we do, we would advise them to reinvest as much as they can in their businesses and grow that way. But I suspect it's because a lot of them are very cash generative and growing, that there will be a healthy dividend being paid. But we don't target the dividend, obviously.
And so with 2 years into you running the fund, what's the sort of time frame that we should be judging you over, do you think?
I think that the time frame, if I may respectfully request, is the same time frame that we judge our businesses against, which is 5 years plus. I think the nature of this fund is that it is fairly concentrated, and as I said, it has very high active shares. So performance will be unquestionably volatile in both directions. I think it's just the nature of the beast. But we very much hope and try our best to deliver great returns for shareholders over 5 years and beyond.
Cool. All right. Well, we'll probably get you back and find out how it's going in due course.
No, it's great. Happy to catch up.
Thank you very much indeed for that. I think that's all the questions I can see. So thank you again, and thank you to everybody that listened in. And we'll be back next week as usual. And look forward to welcoming you then. Thanks. Bye-bye.
Thank you. Bye.